Good morning and welcome to the latest installment of the Austin Associates webinar series. Today's topic is pricing highly volatile commercial real estate loans under Basel III guidelines. My name is Andy Morgan and I'm a principal here at Austin Associates and I'm managing director of our financial management division. Our other presenter today is my partner Jeff Morris, who's also a principal and managing director within our FM division. Jeff serves as Austin Associates lead profitability analysis consultant, while I develop software tools designed for community bankers. Together, we work heavily with the firm's loan and relationship pricing system clients, as well as our comprehensive profitability analysis clients. I just want to go through a few technical instructions before we begin the presentation. During the webinar today, all participants will be muted. If you have any questions, they should be typed into your GoToWebinar participant control panel. We will respond to questions at the end of the session. If we are unable to get to your question due to time constraints, we will contact you directly to respond. All participant names and corresponding questions will be anonymous to other webinar participants. If you get disconnected for any reason during today's session, please try to reconnect and call back via the telephone call-in option or connect using the voice over IP option from your participant control panel on your computer and follow the instructions. If you're having any technical difficulties during the presentation, please try to contact Lisa Cordier here at our office at 419-841-8521. This webinar is being recorded for distribution via the Austin Associates website. We normally get quite a few requests for the webinar slides as well. You'll be able to download the presentation, both the recorded version and the PDF version of the slides from our website later on this afternoon. So that should handle the technical instructions. At this point, we're going to dive into the presentation. I'm going to introduce Jeff Morris here, and he's going to kick us off today.
Thanks, Andy. As you all know, we're still awaiting final resolution of the NPR related to the Basel III capital guidelines. Today's presentation is being presented under the presumption that two things. One, the guidelines will be adopted very similar to what is under the current proposal as being discussed, and that there will not be a broad-based blanket exemption for community banks. So with that as kind of the backdrop, what we really want to get into and talk about is the impact that the newly proposed Basel III guidelines have on highly volatile commercial real estate loans, what's defined as highly volatile loans. But first I'd like to just kind of go through, just so everyone has kind of a common understanding of what's in the proposed guidelines. The guidelines do implement a new capital measure called Common Equity Tier 1 Capital, CETI, CET1, and that's in addition to several other capital measures that have been in place for a while. Probably the largest single implication is the new rules will raise the minimum standards for a bank to be considered well capitalized, not only under the new Common Equity Tier 1 capital, but under all of the prior existing capital measures. And we'll go through that in just a few minutes. But it's this increase in the minimum standard that is going to have the biggest impact for community banks going forward. A slight positive element coming out of the proposed guidelines is the new guidelines do allow for AOCI, accumulated other comprehensive income, to be counted as capital, and that has a small positive effect for most banks that we've analyzed, depending on what that number is within your overall capital account. But the net effect of the proposed guidelines is a very substantial reduction to the measured capital level of most community banks. Community banks that are in a position of having excess capital today will find that that amount of excess capital erodes very significantly the day on which the proposed guidelines would be implemented. So we're going to walk through some examples of all that, so you'll get a feel for that in greater detail. But those are the main points of the proposed regulations. The regulations go further into defining what is a highly volatile commercial real estate loan, and there are really two parts to that. The first part is all acquisition, construction, and development loans qualify as highly volatile commercial real estate loans. And then other commercial real estate loans that have loan-to-value ratios outside of the supervisory guidelines that vary from type of property to type of property, anywhere from 65% loan-to-value ratio up to 90% loan-to-value ratio, depending on the type of property. Any loan-to-value ratios above those guidelines will put that other commercial real estate loan into the highly volatile category. So one of the first things you want to do is get a handle on the identification within your current portfolio of any loans that fall into either of these two categories. Additionally, I'm just going to cover this information, though it's really kind of outside the scope of today's, the focus of our presentation today is the highly volatile commercial real estate loans. But we do want to mention the impact that Basel III has on 1 to 4 family residential mortgage loans. That's actually, in many cases, for most community banks we've looked at, even a greater impact to the reduction in your capital as a result of the definition of Category 1 and Category 2 risk-based 1 to 4 family residential mortgages. And again, that has completely to do with the loan-to-value ratios on those product types and increasing the risk weighting of assets applied to those product categories. So in addition to that, and it's probably minor for most community banks, there are higher risk weightings for past due loans, risk weighting of 150% for past due loans. Hopefully that's becoming less and less of an issue as the economy improves and things move forward for you and your community bank, but that is an additional consideration, and it will require some additional capital allocation under the proposed guidelines. So what we'd like to do is kind of walk through a example, a case study, if you will. This is looking at an actual commercial bank, a bank that has $600 million in total assets and $70 million in capital. The first thing we're going to do is look at the three traditional or historic capital ratios, capital measures that have been looked at in the past: the leverage ratio, the Tier 1 capital ratio, and the total capital ratio. Under current guidelines, this bank has a leverage ratio of 8.36%, and current guidelines suggest that that number should be above 5%. Tier 1 capital for this bank is 10.89%, and guidelines call for it to be 6% or higher. And the total capital ratio is 12.14, with guidelines suggesting that number needs to be 10% or higher. So under all three of the prior existing capital measures, this bank has a very comfortable cushion of excess, what we'll call excess capital. The calculations under the new rules, or the proposed rules from Basel III, the capital conservation buffer, as it's called, the CCB, there are some slight changes in the way that's calculated. There's some slight calculational differences in what goes into the numerator and the denominator of each of those prior existing ratios, such that the numbers do in fact change. Tier 1 capital drops in the new calculation from 10.89 down to 9.88%. But the bigger item of impact there is that the standard gets raised by the new Basel III guidelines from 6% to 8.5%. And that's probably the biggest impact of the newly proposed guidelines. The total capital ratio falls from 12.14 to 11.13, and the guideline minimum standard is increased from 10 to 10.5%. The new common equity Tier 1 ratio is established at 9.88%, and the standard for that under the proposed guidelines is 7%. So the item that impacts capital most directly and most immediately for this bank is the Tier 1 capital ratio. So we're going to be talking about that a little bit more in a minute. Further assumptions that we will make as we look at this is that the portfolio of this bank of highly volatile commercial real estate loans is made up of about 15% of the total portfolio falls into that. That will be made up of both the acquisition, construction, and development loans, as well as the commercial real estate loans that have loan-to-value ratios above supervisory guidelines. So that's the 15%. We're also going to make an assumption that the mortgage loan portfolio, the portion of that which falls into the Category 2, the higher risk category, is 10% of that mortgage loan portfolio. And then the bottom of the slide breaks out what the loan-to-value ratios are and what portion of the current portfolio we've assumed fall into each of those loan-to-value tranches or categories, if you will, for each of the Category 1 and Category 2 loans. Those are just inputs to the calculation that we'll be seeing here in a moment. Our assumption is that most banks have gone through the process of modeling and analyzing the impact to capital at their own institution along these same lines, and that you've either made assumptions about the portion of your portfolio that fall into those categories or have measured actual results of loan portfolios that fall into those categories. We found it's most common that banks are simply making assumptions as updated appraisals and the other information that's necessary to calculate those assumed levels of the loan portfolio that falls into each of those categories probably don't currently have the information to do that accurately and concretely. So back to the example of this $600 million asset commercial bank with $70 million of capital. Prior existing excess capital, and here we're just going to be using the Tier 1 capital, the prior existing capital ratio. 51.2 million would be the actual capital level that's defined as Tier 1 before the change in regulations. The minimum level set at 6.0%. Currently, but defined at 8.5% currently, but being changed to 6% under the new guidelines, gives the bank 28.2 million of existing capital as a standard. The excess capital that they currently have is $23 million. And that's before the rules would be changed. After Basel III is implemented sometime in the future, the capital conservation buffer is increased to 45.7 million. There is a small increase in the actual available capital from 51.2 up to 53.1, and that's the inclusion of the AOCI, other accumulated other comprehensive income that we talked about earlier. That is a small increase to capital, but there's a very, very large increase to the minimum required capital at 8.5%, equating to 45.7 million of capital this bank must hold under the new guidelines. That's nothing has changed from the day before the rules are adopted to the day the rules are actually adopted, and immediately the capital requirement goes up to 45.7 million. The excess capital of this bank changes overnight to 7.4 million from the prior existing 23 million, a 15.6 million drop in capital. So what all caused that? Let's take that apart piece by piece and try to understand where the bulk of that capital goes according to the change in guidelines. The number one element that caused that $15.6 million of capital to be viewed as disappearing under the new proposed guidelines. 11.8 million of the 15.6 is defined away based on the increase in the minimum standard of capital, Tier 1 capital, from 6% up to 8.5%. The increase in the risk weighting of assets, which includes the highly volatile commercial real estate loans, acquisition and development loans, as well as commercial real estate loans with loan-to-value ratios above minimum supervisory guidelines, as well as the impact to the mortgage loan portfolio, takes 4.0 million of capital away from the defined excess capital of this institution. There's a very small positive impact in that AOCI definitional change. Picking that up and being allowed to count that as capital in the future actually improves the situation by $200,000, a very, very minimal, almost insignificant amount. So with that as kind of a backdrop, we're going to dive here in a minute into the impact that that has on loan pricing decisions for either AOCD, acquisition, construction, and development loans, or the highly volatile commercial real estate loans that are have loan-to-value ratios above supervisory guidelines. And what you need to do is identify what those loans are, and as you either continue to make those loans in the future, or as you refinance and reprice those loans going forward, you need to take into account in the pricing of those loans the impact that this added capital requirement has on you. And we're just going to walk through a few examples to demonstrate that point. And I'll turn it over to Andy to cover that.
All right, thanks, Jeff. Well, I think that was, Jeff gave a pretty good backdrop on kind of the macro view or the bank-wide view of what some of these proposed rules are going to do for community banks. Like he just mentioned, what we're going to do now is go through a case study, more on a micro view approach of when you're in pricing individual loans, individual customer relationships, what kind of impact are these proposed rules going to have on those pricing decisions? So let's take a look initially here at a standard commercial real estate loan. We're going to look at a loan that's going to be for $500,000. We'll initially put our loan rate in at 4%. We're going to lock that rate in for 5 years or 60 months. Credit quality becomes very important within any pricing model. The screenshots we're going to show you today are out of the Austin model, but it doesn't really matter which model you're using, whether it's a third-party model or an in-house model that's been developed within the bank. Credit quality is a very important piece of the way profitability gets analyzed. And then the last bullet point there is, we're initially going to start with a capital allocation level of 9%. Under the current rules, where we're coming up with that 9% is if you look at the leverage ratio of your institution, you're normally going to want to start out with an assignment to your 100% risk-weighted assets, such as these commercial loan product types, with that current leverage ratio. So that's the set of assumptions we'll initially start with here. So let's take a look at the profitability results of that loan that we just set up on the previous slide. So again, to kind of summarize the basic loan assumptions, we're looking at a fixed rate loan for $500,000 at 4%, fixed for 5 years, and we're amortizing over 15 years or 180 months. Now, a big assumption we're going to make here in terms of being able to calculate the ROE metric is obviously the level of equity or capital that we're going to allocate to this product type. So again, the 9% is where we're going to start. You can see we have an adjustment, the ability to adjust this capital allocation based on this new risk adjustment that we're building in to handle some of these proposed rules. So the initial assumption here is we're going to look, assume this loan is what we call moderately volatile, kind of the default level. We're going to assume it's still a 100% risk-weighted asset. We're going to stick with that 9% allocation. The profitability results of a loan of this type, you can see at the top right-hand side of the screen, the annualized profit, average balance, given a typical amortization, is going to be about $489,000. Profitability in terms of dollars in that first year is just shy of $6,000, and it's going to equate to a 13.45% ROE. Now, we've put a hypothetical target out here right now of 15%. Obviously, that's going to vary within each of your individual institutions, as well as within different product types within your institutions. But that's the target we're going to go with for right now. So what we can do within the model, we actually have a link out here. It's called our benchmark calculator, and that's immediately going to allow us to solve for different variables that are going to be able to get this loan up to our 15% target level. So this is kind of a blown up screenshot of what that benchmark calculator does for us. Now, normally when you're in using a loan pricing model, you might be trying to hit various targets based on whether you're looking at just individual loans or full customer relationships. We're under the assumption right now that we're just looking at an individual loan, so that 15% ROE is the target we're shooting for. So if you remember back, we initially set this loan up with a 4% rate. What the benchmark calculator is telling us, in order to get this loan up to that 15% ROE hurdle from the just shy of 14% that we had, we'd actually have to raise the rate on this loan up to 4.21. Now, alternatively, the benchmark calculator here also solves for a couple other variables. We can get to that 15% target through loan fees or through the addition of a profitable checking account. In this case, around a $50,000 average balance non-interest-bearing checking account will also get us to that 15%. So kind of keep these numbers in mind, because what we're going to do is we're going to now look at the same loan, but we're going to change one assumption. We're going to change the assumption of this loan being moderately volatile in terms of our risk rating categories, and we're going to change it to a highly volatile commercial real estate loan. So to show you the that simple change, we're going to still look at the same other assumptions: $500,000 loan, 4% for 5 years, average credit quality. But the last bullet point on this slide, what that shows you is the impact of this exact same loan under the new guidelines being highly volatile. So that initial capital allocation that we had in this loan of 9%, this asset would go from our 100% risk-weighted bucket to the 150% risk-weighted bucket. And what that's going to result in is a capital allocation on this loan going from 9% up to 13.5%. So we'll zoom forward here to our results screen. Again, summary of our loan inputs, exactly the same as our initial screenshot. But here's where we're changing that risk adjustment. We've gone from moderate volatility up to high volatility. Our capital allocation has gone from 9% to 13.5%. And when we look at the results of our profitability calculation, what we're going to see is our average balance is the same. Our dollars of profit being calculated are exactly the same. But the big impact here is look at the results of our ROE calculation. It went from before, I think it was 13.5 or so. Now we're down to just below 9% ROE, 8.97. And that's solely due to the fact that we changed the level of capital being allocated to this individual loan. So now if we look kind of at a side-by-side view of our benchmark calculator, the left-hand side shows the first time we ran through this loan with the moderate volatility setting, the 9% allocation. Again, our benchmark calculator solved for the loan rate required to get us to our 15% ROE. That was a 4.21% loan rate. On the right-hand side of this screen is our highly volatile commercial real estate loan. Again, we're shooting for 15% ROE. But what you see here is we'd actually need just about a point higher, 100 basis points higher on our loan rate in order to achieve that 15% threshold in this case. Alternatively, if you're going to adjust your fees or your checking account balance required, you can see the impact there. You need $5,000 more in fees, or you can see the significant jump in the deposit balance required in order to get to that 15% target. So, within a pricing model, you can see the importance that these rules are going to have in terms of the way that your ROE is going to be calculated, and ultimately the level of yield or fee or compensating balances required in order to get similar loans above your target levels. Just wanted to show you just a couple other alternative risk adjustment factors. The example we just went through had to do with the commercial real estate product type and the variation between kind of a default or moderate level of volatility versus the highly volatile bucket. But obviously, there you could really set your risk adjustments up to be whatever you need them to be. You can base them on loan-to-value ratios, debt service coverage ratios. The drop-down box or the screenshot shows you can do it based on a combination of the two. You might want to set up risk adjustments based on different underlying collateral types. So you really shouldn't be limited in terms of the way you're going to adjust the capital that's being allocated to your various product types based on any kind of rigid risk adjustment. You should be able to really define within your pricing model a risk adjustment scaling system that's appropriate for your individual institution. The next thing we want to do is go through another quick case study here. And this is actually a case study of out of our what we call our CAPS model, or our capital adequacy and planning system. So what this system is designed to allow community banks to do is really do some longer-term planning, 3-year, 5-year planning, maybe for use within a strategic plan. The CAPS model is also used to do some high-level stress testing. But really, in terms of the scope of today's webinar, what we wanted to show is, if you're going to be running 3- and 5-year plans, what's the impact of the proposed rules in terms of the capital ratios that Jeff talked about previously or earlier on in the webinar. So what we're going to look at here is an example institution, a little bit smaller than the one that Jeff looked at earlier, $215 million in assets with a current loan portfolio of $150 million. Now, within that loan portfolio, the way that the product mix is broken out, we're going to assume a $50 million 1-to-4 family portfolio, a $75 million commercial real estate portfolio, and then kind of our other category is going to pick up some of maybe the consumer installment type loans and other loans. That's going to equate to a $25 million portfolio. Within the parentheses there, you can see the current risk weightings for each of those portfolios, the 1-to-4 family being normally 50% risk weighted, everything else is in there at 100%. And then the screenshot out to the right shows you how we've assigned those risk weightings to the 3 main loan categories that we're breaking out. So what you see at the bottom of the screen, based on those risk weightings and that mix of balances within those portfolios, we have a total risk-weighted loan amount of $125 million. So it's just it's not the full $150 million portfolio. It's something slightly smaller than that based on those current risk weightings. Now, what we're going to assume here is just a simple 3-year plan. This next screen is going to show you the capital results and capital ratio calculations of a very simplistic 3-year plan that's basically just assuming a modest 3% loan growth annually, funded through some nominal deposit growth. And what we're going to see here is this bank, up at the top, you can kind of see the increase of the bank capital. That's going to be basically through the retained earnings in the plan that we've developed here. You can see the growth in the assets. The important thing to point out here is, the percentage of risk-weighted assets to total assets. In this initial view, under the current rules, that total risk-weighted assets to total asset ratio is right around 69%. So kind of keep that in mind, because we're going to look at the same 3-year plan here in a minute under the new proposed rules. Now, the way that this bank is set up, they have a very comfortable cushion on all 3 of their current regulatory capital ratios over their targets that they've set. And the targets that this bank set are actually quite a bit higher than the regulatory minimums that Jeff talked about earlier. They've set a target of 8% for their Tier 1 leverage ratio, 10.5% for the Tier 1 risk-based ratio, and 12% for their total risk-based capital ratio. But what we see here, you know, if you look at the Tier 1 leverage ratio, they have a cushion of about $2.4 million in that first year. The important ratio here, maybe the Tier 1 risk-based capital ratio, they have over a $4 million cushion in that first year over that 10% target that they're trying to maintain. And on the total risk-based capital ratio, we can see about a $3.8 million cushion currently over their target of 12%. Okay? So under the new guidelines, just to kind of summarize, Jeff showed a slide similar to this earlier, but on that 1 to 4 family residential portfolio, you can see the different breakouts of the risk weightings based on whether it's going to be a Category 1 or Category 2 loan. And then down here at the bottom, again, if we look at highly volatile commercial real estate loans, that's going to go from 100% risk weighted up to 150% risk weighted. So we've expanded our list of loan categories a little bit more within the model now. Before we just had the 3 main categories. But now what we've done is we're looking at that $50 million 1 to 4 family residential portfolio, but we're saying now they have various risk weightings, and we've broken them out based on whether they're Category 1, Category 2, and based on which loan-to-value bucket those balances fall within. So you can kind of see the breakdown that we've assumed for this bank. We've applied the appropriate risk weightings based on the proposed guidelines. We've done the exact same thing on the commercial real estate loans. In this case, we're assuming out of the $75 million of commercial real estate loans, $45 million kind of maintain the normal or default level of volatility. $30 million fall into the highly volatile bucket. You can see the risk weightings that we've assigned there, 100% on the normal or default level and 150% on the highly volatile. And then we've kept all our other loans at that 100% risk weighting. So what that did in terms of our total risk-weighted loans now, if you remember when we first started this example, we were looking at total risk-weighted loans of $125 million. That number has now jumped to $166.5 million. So, you know, quite an increase. In fact, now it's well above 100% of our total loan portfolio, $166.5 million versus a total portfolio size of $150 million. So if we go to our summary screen now within our CAPS model and show you the impact that has to the calculation of our regulatory capital ratios, what we're going to see here is our capital is still going to grow. I mean, we basically are going to have the same profitability projections going forward, but the big impact here is on this total risk-weighted asset number. Before we were looking at total risk-weighted assets. Let me go back there. Sorry about that. Total risk-weighted assets that equated to about 69% of total assets. In our example here, that number or that percentage has grown to 88%. So 69% up to 88%. And we see a total risk-weighted asset number in that first year of $190 million, growing up to over $200 million by the end of year 3. So not much of an impact on our Tier 1 leverage ratio, but if you look at our total risk-based capital ratios at the bottom, what you see there in that first year, instead of having a comfortable cushion in terms of excess capital, we now actually have a shortfall in capital in order to maintain the targets that this particular bank has set. So Tier 1, the excess of Tier 1 capital, it's actually dropped to a shortfall of about 200,000 there, and on the total risk-based capital, we see kind of a shortfall there of 700,000. So we didn't really change any assumptions in terms of our profitability projections, the growth rate we had in this plan. We just wanted to show you the impact of the change of the proposed rules and the impact that's going to have on total risk-weighted loans, total risk-weighted assets.
So this is Jeff. I'm going to pick up where Andy left off there. What do you do, and how do we summarize and pull together some of the information that we shared with you here this morning? We're proposing a plan of strategies and next steps that, there's some preparation that you would benefit from doing now, a little bit of a planning process after that, and then you need to execute that plan along the lines of, if you have not already identified the portions of your currently existing loan portfolio that fall into some of these categories, the highly volatile commercial real estate loans and the mortgage loan, the 1 to 4 family residential mortgage loans that have the higher loan-to-value ratios that require the very significantly increased risk weighting of assets, in some cases to 150% risk weighting, in some cases to 200% of risk weighting. We'd strongly suggest that you go through a process of doing that. What we're trying to demonstrate here is a process of, we believe most community banks today function with some level of either internal or externally provided loan pricing analytics, loan pricing software, loan pricing tools, as well as some form of internal or external capital planning process. And what you really want to do is kind of pull all of that together. In the example we showed earlier of, the $600 million asset size commercial bank, community bank with $70 million in total equity capital, having their excess capital decline under current scenario from $23 million to $7 million, have it decline by $15 to $16 million. That's an issue. That's a big problem, even if you're currently set up where you have a very significant cushion of excess capital. Many community banks are not in that situation. Even if you are in that situation, which we would view to be rather favorable, most banks today have loan-to-asset ratios less than where they would like to be. The demand over the last couple of years as we've come through the Great Recession for commercial loans has been has declined very, very steadily, very significantly. And as you look forward into 2013 and beyond and think about what are the things that need to change to bring your community bank back to the level of profitability that you traditionally have been at and that your shareholders expect, one of the things that you would like to do as the economy improves is increase the loan portfolio size, increase the loan to total asset ratio that exists within your bank. And one of the things that you need to figure out is, are you going to be able to do that if these Basel III regulations get imposed on you as currently proposed? The bank we worked with there in that example had $7 million of excess capital. But if they were to grow their loan portfolio the way they'd like to return to normal levels of profitability and a normal, as defined by prior history, loan-to-asset ratio, you may not have sufficient capital to do that growth. And so what you need to do is, define what these categories that require additional risk weighting of assets, identify what portion of your current portfolio falls into that. Then from there, determine a plan for how you can adjust the product mix of your bank going forward to either rebalance the portfolio away from those loan types. And part of how you do that might be concerned with the types of loans that you will accept new loan applications for. And part of that may have to do with the level of repricing you require to continue to hold those loans in your portfolio. If you have loans that fall in your existing portfolio that fall into the highly volatile commercial real estate category, either as ACD loans, acquisition, construction, and development loans, or loans that have higher than the minimum supervisory guidelines of loan-to-value ratios, you need to do something with those loans as they come up for repricing and renewal that either move those loans out of the bank because you can't afford to hold them because you don't have sufficient capital, or if you're going to hold those loans, that those loans become repriced at a level that adequately compensates the bank for the additional capital that's required to support that lending under the new guidelines. So those are changes you need to make. And given the fact that capital raises for community banks have been fairly difficult in the current environment, current earnings being what they are, current ROEs being what they are, you may want to begin on that process sooner than you actually have to. So we would recommend that you identify these things, start planning for the eventuality of what impact it might have, use your current loan pricing systems to help you determine what an appropriate price is if you stay in those loans, or use your current capital planning model to figure out how are you going to provide adequate capital to support growth in the loan portfolio that will take your bank back to the level of profitability that shareholders expect and you've previously been able to achieve. In Andy's example of pricing a highly volatile commercial real estate loan, he was using 15% as the target ROE. Please recognize with us today that that's a lower level of ROE expectation than community banks, commercial banks have previously functioned under. The competitive nature of the current market environment has driven that number south. 3 to 5 years ago, it was entirely common for community banks to be pricing commercial real estate loans, C&I loans, construction and development loans at 18, 20, or 22% ROEs. The current economic situation, the current competitive situation has driven that number south. What your shareholders expect of your bank is individual, we understand, individualized to each individual institution, and hopefully you have a pretty good understanding of what those expectations are. But you need to take that into account in planning for how are you going to maintain a level of capital for your bank that's going to allow you to grow to the level required to move your profitability back to the level of historical significance. So what are some things we can do to help? If you have an in-house system that either hasn't been working for a while or hasn't been used, if you have some questions about the analytics or the integrity of the metrics in that, something that regulators like to see from time to time is that there's been an independent third-party review of any of those systems that you're using for making some of these types of decisions, whether it's your customer, branch, and profitability analytics, whether it's your loan pricing metrics, whether it's your ALCO system, or whether it's your capital planning model. We can work with you to make sure that the calculations and the analytics within those models are appropriate for the current time. We can do that as either a formal written report, or we can do that as kind of an over-the-shoulder informal, very simple review of your systems. A lot of banks understanding the profitability pressures of 2013, the margin pressures that exist in the current budget year. One of the things you're looking hard at is the operating expense structure of your bank. That's something we've assisted a lot of community banks with, efficiency reviews and operating cost studies to develop recommendations for improving the operating cost side of the institution because it's so difficult to improve elsewhere, including the margin. Analyzing the your branch network as a part of that operating cost and efficiency process is something we've done a lot of recently. If you are short on software, if you don't have a capital planning system, if you don't have a loan pricing model that you're confident in, that you've been using for a while in-house, we have solutions in that area, as well as a deposit pricing module. It's maybe not as important as the loan pricing system today, but it does have a strong impact on the total margin, so that might even be something you'd want to look at. And certainly your product, branch, and customer profitability system If you don't understand the individual customer profitability and the product profitability within your currently existing commercial loan portfolio, that could be something that you'd benefit, trying to prepare for Basel III implementation by understanding who are the most profitable commercial customers that you cannot afford to lose, and who are the ones that need to have their loans repriced up to cover the capital that's being required or consumed by those relationships, or perhaps potentially being moved out of the portfolio. Those are all helpful things that we'd be happy to assist you with.
Well, everybody was shy today in terms of the question box. If you have any questions you want to ask us offline, feel free to contact either Jeff or myself. Also, if you want additional resources either about Austin Associates or previous webinars that we've done, everything has been recorded on our website. Feel free to check out austinassociates.com. Take a look around. We have a lot of good information out there. We'd like to thank you for attending today. We do have our next webinar scheduled in our series. It will be either at the end of March or beginning of April. I'm sure you'll get an email invitation here in the next week or so. That webinar will be presented by our risk management team. They're working diligently on the topic and the presentation there, but look for an invitation for that coming out soon. I'd like to thank everybody for attending today. Again, if you have any questions offline, I'm definitely the better looking of the two of us. Feel free to contact me or give Jeff a call. You can see our email addresses there. Again, thanks everybody for attending today, and we'll talk to you soon.